Mr. R. Gandhi, former Deputy Governor of Reserve Bank of India. He joins in right now. Sir, thanks so much for taking the time out. What is your initial thought? Because it was expected that the MPC will keep, I mean, what the MPC has done is largely what was anticipated. So no big surprise except for a wait and watch mode and some numbers given and some liquidity measures taken. What stood out for you, sir?
That's correct. All around expectations were definitely that MPC will hold on, having brought the rates to so low at in recent times to 5.25. There is further cutting down that is not feasible at all, and inflation is behaving very well. So there is no question of even looking at upwards. So that way, it's a neutral stance and keeping the powder dry and looking ahead with more optimism. So that way, MPC has done what generally everyone believed it will do. There was no other expectation.
What would you anticipate would be, let's say, some telltale comments around both inflation and growth in the next policy, sir, as we move to what arguably will be a new way of looking at these numbers by that time?
Of course, everyone looks forward to the revised way of calculating the inflation and the GDP. So that will give quite a bit of room for discussions and reassessment of the numbers. Basically, it will be the numbers which will be debated upon. Otherwise, the economy, just because we are going to measure inflation and GDP in a different way, the actual facts on the ground is going to be different. No, it is the way of looking at the optics, that is what will change. That's my first interaction. Within short while, the dust should settle down among all the people and move smoothly into the new regime of calculations. That's the first one. Given that, they let that be maybe. My own expectation going forward in the next round, when the MPC will be meeting, that will be in June. Is there going to be a different action within these 2 months? Do we expect something totally different which will kind of disturb the current balance that we have? That is unlikely, because the domestic factors are definitely more positive. Risks are not seen on the downside, both for inflation and growth. If at all, surprises will be on the upper side. In terms of growth, the growth momentum could be further enhanced because of the clearance of trade tariff related arrangements. That would mean that growth, there could be positive improvement that is expected. Inflation unlikely to be rearing its head again. That's also not there. So that would mean that there will be expectations for further action by the MPC. But what action is possible? We will be reducing interest rate. That is going to be difficult for the reason that savers, especially household mobilization of household savings, the large extent depends upon the deposit rates. So any further cut in the repo rate can impact the fixed deposit rate, which a large section of the population depends on. So that's why I won't look at rate cut, rather non-rate cut related way of supplying for the liquidity and supporting the interest rate being up. That's what we should be aiming.
Perfect, perfect. Abhik Barua also joining in this morning on our conversation. Jayesh Mehta with us of DSP Finance. Manish Sonthalia of MK Investment Managers joining in. And of course, Alex there from the Reserve Bank of India right now. Abhik, I want to come to you. Maybe this is sort of a lot that will have to be seen after the new series come in, and that was the sense we got as well. What was your big takeaway from here? Inflation largely in line, slightly up. GDP largely in line, slightly up in terms of projections because of the trade deal, but too early to really bake in all of these fast-moving indicators?
Yes, absolutely. Sort of, I think it was very prudent to kind of not, get ahead of on the RBI's part, not to get ahead of themselves and wait for the numbers to come in. As Mr. Gandhi pointed out, it's unlikely that the numbers will be significantly different in terms of the growth estimates that are currently there. I expect, and I think the market as a whole expects inflation to move up slightly on a level basis from the current series, and perhaps GDP also to move up a little. I second your point that for the first time there's an emphasis on the improved performance of IT services, and I think that's an important signal because there is a lot of concern about where the Indian tech sector is headed. So I think even a brief mention of that was warranted. What I didn't, what was kind of slightly disappointing was the fact that transmission to the government bond market has been very weak. I mean, it's sort of gone the other way. And what has effectively happened is that there's been a sort of a floor set to the GSEC, the critical GSEC yields. And I think a little more sort of assurance, apart from the promised liquidity measures, that rate cuts are possible if things go well, etc., could have helped the market at a time when it anticipates significant bond supply, both from the center and particularly now from the states. States are becoming a bigger player in the bond market, almost as big a player as a central government. So I think that's the bit that I find slightly disappointing, but you can't really blame the MPC. There are too many moving parts, too many unknowns, and I think this was perhaps the best that they could do under this sort of cloud of
But just on that
uncertainty.
point of signaling and how the bond market has taken it, Jayesh, I want to get you in. We have been speaking for the last few days about bond yields, about currency, and what the RBI could say and do and signal. Do you think that enough was said and done?
No, I think in terms of saying, I don't think anything is really required because they've done enough OMOs. Liquidity is very high, and of course, their 10 always has been OMOs are for liquidity. So announcing it doesn't make sense, but I do expect them to aggressively intervene, and they should aggressively intervene in secondary market. While people are feeling comfortable, 665, 670, okay, because it went to 678 and came down to 670, 665. But I think we should really, with the kind of overnight rate we have, we should look at much, much lower than 6.5. And there is a demand supply mismatch, which is very true. Of course, RBI did buy a lot of bonds in last couple of months, but it was much later than maybe hopefully they would have started earlier. But nevertheless, now there's no point announcing an OMO, but at least on and off secondary market, they can actually buy, and they can also do a operation twist, which is buying long dated and selling short dated in the market. So that should really help. I hope they do one before March end.
Okay, so that should ensure that some elements of transmission take place in the bond market. We've also got Manish Sonthalia joining in. And Manish, really from the perspective of the equity markets, what did you make of this? Because ultimately the expectation going in was not very high, particularly because of what Governor Malhotra himself spoke about, the fact that there are new series coming through on growth and on inflation. How does the equity market take this in your opinion?
Yeah, so there was no expectation of a rate cut broadly, and that is what has come about. Concerns were around the liquidity aspect. In spite of OMOs, liquidity has basically remained tight, and we have concerns on the capital markets around the 10-year GSEC yields. I think on that front, whatever could have been done by the central bank has been done, and I think nothing negatively surprising on the monetary policy side as far as the capital market, stock markets are concerned. We are more focused on how the ramifications of the trade deal and how the earnings season would play out. So that's how I would tell.
Okay. Jayesh, your opinion on the liquidity, because Manish is speaking about it being relatively tight, but then the governor is already mentioned, in February you were talking about 2 lakh crore rupees as measured by the liquidity adjustment framework. That tends to reduce a little bit heading into the end of the year and the start of the new one. But do you think that liquidity is going to be an issue? And is the only way in which that transmission in the bond markets take place is if the RBI comes in and intervenes, as you pointed out?
So liquidity, I think they have enough liquidity. They have added up in last 2 months. From December onward, they have been aggressively adding liquidity. So from an overall liquidity perspective, banking system liquidity perspective, we are in surplus, and that's pretty good. So that's not a problem. In fact, maybe a little bit of tweaking on their reverse repo VRRR. That also has helped overnight rates, which has a little bit tightened, but overnight rates are very, very conducive and soft, right? I think the problem is on the 10-year yield or a long-term yield, and that's mainly, if you look at the demand and the supply, right? So total yearly supply of Government of India, and you have three buyers, which is the Reserve Bank, mutual funds, and bank, provident fund, and insurance companies. And you always need a fourth buyer, which normally would be a foreigner or Reserve Bank of India. I think this time, not the foreigner came, Reserve Bank came much later. But they need to come a little bit more aggressive. Also, state loan supply is a challenge. That's huge. That's also causing a problem. And that's where we are a little bit in the conundrum. Maybe this time around, Reserve Bank needs to buy more. As I said, liquidity is enough, so they can't announce in the monetary policy meeting, but they can always do an operational twist, which is liquidity neutral, where they buy long tenor bond and sell short-term bonds. So something like that, I would think they should do before March end. That will help the bond yield.
I just want to get a quick word from Manish. Manish, market's in a bit of a funk right now, and I don't think the policy could have done much to improve the mood. Maybe some talk about guidances and future prospects, but without the new series, really, what can the governor say? What do you think is the prevailing concern right now from a market's perspective?
Is basically the gross borrowing number as announced in the budget, 17 lakh crores, and not to mention the state borrowings. That is keeping your 10-year GSEC yields elevated and transmission not really happening. That is the mood concern of the market, that the market seems to know more than what is being alluded to in terms of policy rate directions. And, it's overshooting that. So from that point of view, does it warrant some policy action is what the markets are concerned about. So 17 lakh crores borrowing number, central government, plus a very big, non-ponderable as far as the state borrowings are concerned, that is keeping the interest rates elevated. That is basically the worrying point.
Okay, Mr. Gandhi, you've heard some of the comments that have come in. Is there a missed trick in this policy, or is it fine and some ground could be covered by the next policy as well? Because we know that the RBI has been the one which has done a lot of action in the past 12 months as it is.
Obviously, in this policy, there has been no explicit or implicit further action, what you are referring to. But probably the April policy, we can think about something more specific. But again, I would believe that monetary policy typically looks into the credit rate, because the aim of monetary policy is always to influence the prevailing interest rate in the credit market, not in the GSEC market. GSEC market behaves more in relation to day-to-day movement in liquidity. So that's what is the amplitude, quite a bit of ways it will be happening. In general, monetary policy actions should impact GSEC rates on a stable basis over a period, but there will always be day-to-day movements. That's what. So that's why obviously market is factoring in quite a lot about the gross borrowing limits. Proposed target in the budget is quite high. So whereas the net borrowing is definitely well within the, in comparison with the last couple of years, it is similar. That difference, why the market is a little bit worried about, is because of the day-to-day movement. Day-to-day movement in liquidity and the continuous borrowing by the government, both central and state government, including week after week, they will be demanding money. So that is what is disturbing the movements in the GSEC market. That's where, just now, as JS mentioned, the Reserve Bank should be thinking about some policy rate related way of managing the GSEC rates, so yield. So that's what I should be expecting in the coming months.
Jayesh, you mentioned about one factor, of course, and I'm sure Alex has more questions, but is there something that was a pressing need and not done in this policy, which was a low-hanging fruit or a low ball outside the off stump, which the Reserve Bank should have tackled?
No, I don't think so, because
No, right?
global environment is such, I don't think they can do anything very out of the turn. You see, this is more like monetary policy. Within the ambit of monetary policy, whatever they could do, they have announced it, right? Anything outside that, they can always do it from without the monetary policy, right? They can always issue a circular or guideline during till the time of year end, right? So I do expect something there. As I said, like Operation Crisp is something very heavily on the mind. And even for next year borrowing, right? It always depends. See, I think the budget number is for 1 week or so for the traders to, it's more or less or whatever it is to get excited. But ultimately, how much support the Bank of India does at the right timing. It's not about just supporting the bond yield or doing the OMO at the right time. That gives the market sentiment. So 50,000 or 75,000 more or less borrowing does not really impact yield on an overall yearly basis. Maybe yes, at the beginning from a sentiment year.
Okay, I think we've got Ashwini Kumar Tiwari as well, MD of CBNS and SBI joining in right now, and great to have a banker on the panel as well. Mr. Tiwari, thank you so much for joining in. Your first thoughts on the policy, did it tick mark most things that you had in mind, or was there something around liquidity, something around commentary that you would have hoped for further?
Thank you for having me. So first thought is that the policy was on expected lines as far as the repo rate is concerned. We did not expect the rate to be cut this time, and we did not expect the stance to be changed. We expected consistency, and that is what the policy has delivered. So in that sense, it's a consistent and expected policy. Second is that as far as liquidity, I hear a lot of chatter on liquidity that maybe they should have done something. I think the governor made it very clear that liquidity is something that they will constantly monitor. And as and when there is need for taking any steps, they will take. In fact, yesterday they had a very successful OMO. So going forward also, we expect OMOs to happen and or other steps to be taken as and when needed. Quarter 4 is always something where the RBI is very keenly watching because there are tax outflows, there are various other payments, etc. to be made. So therefore, liquidity is generally under pressure. So I'm sure the RBI, being watching it, will take steps as and when necessary. The third piece is, of course, there were a lot of announcements on the banking and the financial sector, which of course we can't predict because those are some things which the RBI has been working on, and then they announce as and when ready. Out of those, I think the allowing the banks to invest in REITs, the real estate investment trusts, I think that's a very important announcement as far as we are concerned, because it opens up one avenue which was so far closed to the banking system. So we'll wait for them to tell us the details and the guardrails. But it's already a 2 lakh crore market, and we expect it to get to, growing at 25%. So very, very important announcement, that one. And of course, the others on the digital protection for senior citizens, for others, increase of collateral-free loans for MSMEs, those are all there. But I would rate the REIT announcement the most important, which is something we've been engaging in the RBI to allow us to do that.
Oh, very interesting, Mr. Tiwari. In fact, I was going to ask you about the MSMEs, but let me ask you a broader question first, which is that Governor Malhotra alluded to improving credit growth. In fact, he spoke about the system as a whole, and he said that it's coming towards 13.8, close to 14%. As the largest lender in the space, can you give us some insight into which pockets you're seeing this growth in? And two, what is the implication of the increase in that collateral-free loans to MSMEs? Is that going to tide some of these entities over what could be a little bit of a tough time?
No, so we have seen good growth with our bank also for the last 2, 3 quarters, and all sectors are growing, whether it's retail, whether it's mortgages, agriculture, MSMEs. Only the sector which was not growing as fast was corporate, and that too had a 7% growth in September. We expect that to do better in this quarter. And therefore, all sectors are growing, very good credit growth. And I think this is very much needed. If you look at the larger picture, the credit to GDP is still 56% in India. And if we have to achieve the Viksit Bharat goals, we need to actually triple this number. So I understand, of course, that in 1 year we can't do it. But if we have a consistent 12 to 14 or 15% growth over a period of time, I think that would go a long way in boosting credit growth across the sectors. So that's on the credit growth side. Now, on the MSME, I think the collateral, nobody was asking collateral for MSMEs because they are all covered under the CGT-SME scheme. The difference is that now we will not ask for even this cover up to 20 lakhs. And to that extent, this fee, which was paid about 1.6%, will also not required to be paid. And that will make the MSME credit more affordable for the smaller SMEs. So in that sense, it's a good measure because the smaller SMEs are not that strong financially, and they need all the benefits, all the support they can get, both in availability and affordability, which is what this announcement has done.
Mr. Tiwari, of course, you can comment primarily about your bank, but in your opinion, therefore, from what you're saying, the opportunities that you're seeing right now would suggest that FY27 could see a significantly higher rate of growth. Could we head towards the higher teens?
So our in-house forecast was 10 to 12, and we have increased that slightly in the recent past. So I do think that the next year is going to see maybe a higher growth because one, we have some levers opening up. I mentioned REIT, which is we also have the mergers and acquisitions, final guidelines coming up. So these levers which were not available will be available next year. And to that extent, I think we will have further possibilities and chances to grow more. So I do see the growth increasing beyond what we have achieved in this year. I agree with you on that.
Fair call. Mr. Tiwari, we'll leave it at that. Thanks so much for taking the time out and being with us. Really appreciate your time.
Thank you.
A question to Abhik and a question to Manish Sonthalia. And then, of course, we'll have a follow-up with Jayesh Mehta as well. But Abhik, the policy had the much expected mention of a growth impetus. Okay, we've not, but okay, Manish is there. Manish, the policy had a much expected mention of growth impetus coming in through the trade deals, but also mentions of how the actions that have done in the past will help growth in urban India. Rural is picking up a mention of IT service businesses results, which I've never heard the RBI say. All of that come in. Now, the fact of FY26, Manish, has been that everybody's underestimated growth and the reported growth, the real growth, not the nominal one, has been higher. Can that trend continue with all the moves that have been done thus far?
I hope so, and it looks like that whatever projected numbers have been made by the central bank will come about, and we'll do slightly better than that. Of course, in the backdrop of whatever we are hearing about in the IT space, because Indian IT is traditionally IT services and GCC, and if AI disrupts, then obviously that will have ramifications on our overall fiscal maths, the receivables that we have from IT exports. So that will also have a lot of impact on the BOP, etc. So everything said and done, markets will consider nominal GDP growth because we talk about absolute profits, and absolute profits have everything to do with nominal GDP growth, not the real GDP growth. Real GDP growth is very good, but at the same time in the budget, we are working with 10% nominal GDP growth. So all assumptions on the Nifty 50 earnings growth will be centered around what the nominal GDP growth looks like, plus something added to nominal GDP growth. So FY26 10% is what will come about in terms of Nifty 50 earnings growth. FY27 hopefully we should be closer to 14 to 15%. I think there is no change in assumptions given this monetary policy on those aspects, as well as the budget. I think it's broadly played out, and trade deal should help at the margin.
Well noted. Jayesh, what is your own assessment, either your or at the house, around what growth could do? Because while we've been punching above our weight, very likely Q4, because of a lot of things that have happened, could be higher too. The world is not necessarily a place of growth. Isolated pockets, select pockets of Europe, US, yes, doing extremely well, but not that the rest of the world is really going gangbusters. Can India continue this growth surprise with the moves that have been done by predominantly by the Reserve Bank of India, but also the income tax and GST cuts, or is there more needed? And is there something that the RBI can do to facilitate that?
So I think I'll give you a very different perspective, which I was also surprised, right? So when you meet the management and when you meet the promoters and all that, they have been quite upbeat and bullish. And when you meet the fund managers, they have been very bearish on the growth prospect, right? And I think that's what I tried to ask some of the guys, and somebody actually gave me a reply. It's more because the fund managers look at the adjusted inflation adjusted growth, whereas the promoter management is okay with volume growth, right? And the volume growth is happening at most of the places. So it's a very different perspective they are looking at, and maybe the fund management is not aligned. And of course, there is an overhang of FPI selling, right, which is a different ballgame altogether. Maybe at some other point of time we can discuss that. But there's an overhang of FPI selling, which is kind of also reflecting that pessimism comes on the growth. The same growth numbers, even the volume growth would have been accepted very nicely if the negative of FPI outflows were not there. And same thing is on the currency side, right? We think that currency is getting people are not coming in because of currency, and in currency market we think currency is impacted because of regular FPI outflow, and that's something we need to really worry about. But otherwise, I think overall growth projection, talking to the management, there is definitely volume growth. Maybe from a company point of view, margin growth may not be there, but definitely volume growth is what everybody is upbeat about, and local.
I do want to ask Mr. Gandhi what he thinks about inflation, because the governor spoke about it himself. But if you look at what the new series is going to do, or the new base is going to do, and the introduction of these new items, Mr. Gandhi, 358 items up from 299, and the reduction in the weightage of food. But core at this point, excluding precious metals, and Governor Malhotra spoke about it, is soft at 2.6%. Is that a concern for you? Does that change materially when the new series comes through, in your opinion? Is that what the RBI knows and perhaps hasn't spoken explicitly about?
Yeah, in the sense that what is going to come in the new series, some kind of understanding definitely Reserve Bank will have, because it is part and parcel of the discussions. They would so they would be actually, I would believe that they would have calculated the inflation forecast based on current methodology and the probable new methodology. So that some kind of view Reserve Bank must have heard about what is the likely impact of the new series. It may not be the complete one, obviously, because until the decision is taken and announced, it may not be the complete one. But an indicator they would have definitely got a sense of what is likely to be there. So accordingly, their projections and their assessment would have got some influence about the oncoming new series. I would believe that it would have been there.
All right. Well, gentlemen, all of you, thank you so much for taking the time out and being with us on this policy coverage. Not much was anticipated, not much has come, but that is not necessarily bad news this time around. Wait and watch for growth to come in. Really appreciate the time from all our panelists. The markets, though, at the lowest point of the day. So not a happy hunting ground, really. I wonder if the markets are anticipating more. This shouldn't have been, ideally. But this may well more be that if the policy is not delivered, then we go back to what the global markets are doing, which is a rough ride of red across the board, starting with the US markets yesterday to Asia today. We haven't had a great outing thus far, and maybe the Nifty is reflecting that.